Hey everybody, it might be kind of loud, but we're here at Signature Flight Services in Boca Raton. What's that?
It's a very good loud.
It's a good loud. Yeah, why is it
You
good,
got
good loud?
exotic because you got exotic cars like this Lamborghini backing up right here.
Here.
That is loud, but
There
it's a
it
very,
is.
very good loud.
Yeah. Okay. There you go.
They're very calm.
And check out that Gulfstream, that G5 back there. That's pretty cool.
And the runway show.
Yeah.
We're at the Wings.
And the fashion show.
Whatever we said.
Wings, Wheels, and Fashion.
There you go.
Wings, Wheels, and Fashion. So this is George Gammon. That's Ken McElroy. And I'm Jason Hartman.
What's happening?
Yeah, what's happening, folks?
I just have to sit down and bend over.
Yeah.
I'll tell you one thing is happening. Florida is open.
Florida is open for business, and nobody's wearing this.
No mask. They gave us seats at the door, but they said no one's
maybe don't
wearing
wear
it.
it.
You know, it's kind of nice.
Yeah. Hey, so to afford all of these toys here, like a $20 to $60 million private jet, $400,000 cars, what do you have to do that? You've got a couple of Ferraris, you've got a whole bunch of exotic cars. So what do you have to do that? What does Robert Kiyosaki, we were just talking to him, what did he say about that?
Cash flow, baby. Cash flow. You know, there's nothing wrong with capital gains, but you have to have some cash. At the end of the day, if you sell everything, you want some recurring revenue.
Of course.
Right.
Yeah.
So cash flow.
But specifically, Ken, about the idea of if you want a new toy, then you need to buy an asset that'll pay for the toy.
Right. So I'll buy a multifamily property that kicks up the cash flow to pay for the Ferrari.
Right.
Yes.
Or even a single family or whatever.
Yeah, exactly.
It just depends on the
So
scale.
instead of buying a car that depreciates,
you
buy an asset that the people pay off for you, and then you put that.
So the
money.
people are making you Ferrari.
Yeah.
And by the way, that's what I always say, folks. We don't pay our own debts with real estate. We outsource the debt obligation to people called tenants. They pay the debt and pay us a little extra every month.
Yeah.
It's like positive cash flow.
Yeah, you got to have cash flow, but you got to work your ass off. That's the name of the game right now. And I think we're losing that in the United States right now. We're getting everything handed to us as a society.
It's terrible.
And we're forgetting that. It's interesting. When I grew up, your buddies. No one ever talked about investing in the stock market to get rich or doing. But when I was growing up,
saving money.
It was saving money, working your ass off, starting a business, producing a good or service that people value more than the money in their pocket.
Right.
That's how you get rich.
Yeah.
But now it's completely flipped on.
Because you've got to speculate so much.
You got to gamble, and it's all about capital gains, and who cares about the cash flow? Right. We just want something that's going to triple in value for the next 3 days.
Which really, if you think about that, isn't that an immature style of investing?
Well, it's a lack of sophistication, it's a lack of wisdom, it's a lack of experience, because there's only so far that game of musical chairs goes before it ends.
But also, when we were growing up, the dollar was tied to gold.
Well, when you were growing up.
Yeah, when I was growing up.
When I was growing up.
Yeah.
That
was pretty much going.
Yeah.
Nixon, that was only 70.
You heard about
71, right?
Yeah. Hey, this is the 50-year anniversary of that.
Oh, that's true.
Yeah. August will be 50 years off the gold standard. Since Nixon closed the window and temporarily closed the convertibility of the dollar into gold, right? Temporarily for 50 years later.
But since then, man, it's been a floating fiat currency.
Yeah, but the thing is, though, with the way you invest, it's something that actually...
Keep talking, I'm just going to show them some view here.
Yeah, it just plays into the inflation narrative. That's what the trend... If they're able to create inflation, who knows? Who could have a deflationary bust, you never know, but... it definitely puts you on the side of inflation, like shorting the dollar, like we said last night. But, going back to cash flow, and you got someone like Ken that started off just understanding the property management game. That's really the hardest part of the equation.
That's where the rubber meets the road.
Yeah, that's right.
Or on these cars with these giant tires here.
Yeah, literally or figuratively, right.
Yeah.
So that's where Ken really got his experience, and he just parlayed that into just bigger and bigger and bigger, just scaling what you're doing. But really what Ken does right now is still the exact same as someone who's 20 years old, 30 or 40, who's buying their first rental property.
Right.
The process is the same, as Ken does it at scale.
Yeah.
That's all it is. Yeah. You can do it on 1 year.
So that's why people that want to be here, maybe they want to buy their own jet or whatever, You know, you say, well, I'll never ever get there because I'm just starting with one rental property. You shouldn't have that mindset. If you want that, that's
Everybody
fine.
starts somewhere.
That's right.
Yeah,
That's right.
no question about it. I mean, there was a time when I was poor and I was 20. I bought my first rental property and built up from there.
Yep.
But here's the great thing about we don't have a good cameraman.
Yeah.
That's all right.
Yeah. But here's the funny thing. Ken said to me maybe an hour ago, right? We're looking at this Rolls Royce that I really like, and I said, Ken, that's $404,000. My birthday's in October, and he goes, Jason, that's a line item. So he can just pay for that for me. Yeah. So thank you in advance for my birthday.
Instead of COVID, it says Rolls.
Yeah.
You know, one thing though that you say frequently that I think people might just overlook or they might not pay that much attention to, but it's very powerful, and that's that you need the asset that you're buying needs to make sense from day one.
Right. Absolutely.
Because then if the price goes up or down, it really doesn't matter to a significant degree because you're buying it for the cash flow.
Right.
And that's why when I talk to people, they always ask me how I invest. I say this 10-80-10. And the 80% of the portfolio is investing, which I define as something that pays you to own it.
Absolutely.
And that's the reason why, because I can be a dumbass, I can be stupid.
Yeah.
I don't have to be sophisticated. I don't have to predict the price direction because it works for me from day one. The numbers pencil out because I'm buying that cash flow.
If the property doesn't make sense the day you buy it, you don't buy it.
Right. Yeah.
Unless you're playing with a small portion of your net worth.
Yeah, but my point, it hedges price fluctuations. Because if you're not going to sell it for 20 years, what do you care if the price goes up or down from year to year? You just don't care. It's like buying a McDonald's. It's the exact same thing.
You don't worry about it. So what I say about that, you say it a different way, and what I've always said is that the definition of an investment is something that produces income.
We say that.
What's
same thing.
Big now is, of course, cryptocurrencies and Bitcoin. They don't produce income.
Yeah.
So, but, people have made fortunes.
Yeah, but that's why I divide that portfolio into a 10-80-10.
Yeah.
So you've got a 10% allocation to speculation,
right.
which Bitcoin would fall into, or uranium or platinum or things that you own.
Or, you've got earned income, passive income, and portfolio income.
Right.
And, and the one that's the strongest is passive.
So how much of your portfolio do you allocate towards speculation?
Probably less than 10%.
Your personal portfolio?
Yeah, less than 10%.
Because you're a real estate expert.
Yeah, right.
So, I mean, you can get such a bigger return.
Right.
So better risk
reward. Yeah, because I'm actually pulling that money away from stuff that I know is going to produce cash flow. So I'm really banking on capital gains. But I definitely do it. But, because we're at the point now that almost everything we're doing is cash flow.
Right. Yeah. But, another interesting thing, and we were talking about this today, we've talked about it before, is in the world we live in, some refer to it as financial repression, right?
Yeah.
Where basically, like you said, when you were growing up, people could literally get ahead by saving money, right? That was a legitimate idea.
Well, that was the objective. That was the way you got ahead. That was the mainstream narrative.
Right.
That you get ahead by working hard and producing more than you consume.
But that narrative wasn't entirely false, and what made that narrative become less and less true over the years is these artificially low, repressed interest rates.
Inflation.
Inflation
because you get negative real rates.
Right.
So the rate of inflation exceeds what you're getting in a bank. Therefore, you're losing purchasing power by actually saving, which forces you to go and speculate. And if you're not a real estate pro, or if you don't listen to JasonHartman.com or your YouTube channel, then you're going to go out there and you're not going to know what you're doing. And most likely over the long run, you're going to lose, even if you're making money short term on these capital gains.
So, because you were born in the 80s.
No.
And,
Yes.
He's going with 80s, folks.
18% interest rate.
Well, at 80, 81, for Volcker.
Right? And we had some pretty high inflation.
In the 70s,
Yeah, in the early 80s. And Paul Volcker broke the back of inflation. But the point I want to make with that is the way you said it today, and I've heard it before that way, is that it forces people to go higher up the risk curve.
Further out the risk curve,
Yeah, further out the risk curve. And take risks they shouldn't have to take.
True.
That's right.
Like older people
like
are
Bitcoin.
speculating in crazy stuff that normally would just
private
have
equity or
laddered
angel
CDs.
investing, which is great, but that shouldn't be 90% of your portfolio, which is what you need to make it right now in order to get it 12%.
Let's get this Lamborghini here, right there. Yeah. Oh, there's another one over there. So, you just got to rev them up, right, to show it off.
We got to shift. I think they're moving around the cars. That's why they're doing that.
Well, the Jeep here isn't moving. We're resting on the Jeep.
On this Hummer,
yeah. Okay, so what other ideas you want to share, and let's wrap it up.
I think that's it. I think that we gave them some good nuggets of information, kind of gave them insight on the stuff we talk about as a group.
Don't get discouraged by the news. You know, all the law changes and all that stuff, because you just got to work with it.
Right.
You got to remember that there are places in the world that are free and open up, and hopefully the place where you are, if you're restricted right now, that your place will open up in the near future as well. I've done a lot of research on the Spanish flu in 1918 to try to get my head around what's happening today, and we are not living in unprecedented times. A lot of these well, not necessarily the extent of the lockdown, but we saw some very draconian measures back in the late 19-teens and 1918.
Let's get that. I got to get the whole parade is leaving, George. Excuse me 1 second. Yeah. There they go. That's not all of them by any means, but okay. Spanish flu is what you were talking about.
Well, but after the Spanish flu, we had the Roaring 20s. So I mean, I know it's a lot different right now, but just there is a way to look at this as the glass half full, to be optimistic about the future, although there's a lot of crazy things happening right now.
Okay, so that's the point. Ken says don't get discouraged about the news. If you want to buy doodads, make sure you buy assets first, so you can afford the doodads.
Yeah, okay? If you take out debt, make sure it's on an asset that's going to pay you to own it.
And fixed.
Yeah.
Right.
And there's a lot of other advice, but you guys can get that on the podcast. Oh, and now we got a helicopter. I just want to show. I'm going to end it over here. I want to show them this Gulfstream. This Gulfstream. I was in this Gulfstream earlier. This thing is incredible. Now they don't make that anymore. That's the G5. But yeah. So, here's another Rolls Royce. You can't even see it. It's so dark. Yeah. But, what's your favorite car here?
I mean, take your pick.
Ford GT. I like the Ford GT.
Yeah, I love the Ford GT, but that Pagani is probably.
Okay,
I love the Lamborghinis, I love the McLarens, the Ferraris, but the Pagani is just so rare and unique.
And that's about $2.6 million.
Yeah.
Pagani, yeah.
How much is the GT?
Oh gosh, depends on the year, but probably.
Yeah, the new GT.
Yeah.
The 2017. I think that's about $1 million now, something like that.
And then we had the Carrera GT too.
Oh, that's amazing.
That's a
It's
nice
just
car,
an old school supercar. Yeah.
Yeah. So there's the cars and the planes and the fashion shows going on. So we want to get back to the party, and all the drinks are included. So we got to go, folks. Good night, everybody. Happy investing. Cheers.